Index funds versus stock picking, the 50-year study. Welcome back to another Solid Right update. Be sure to stay informed and stay ahead at solidright.com. Get the step-by-step implementation guide at automatedwealthbuilder.com. Warren Buffett made a $1 million bet that a simple index fund would beat hedge fund managers. He won, easily. Here's what that means for you. In 2008, Warren Buffett bet $1 million that a simple S&P 500 index fund would outperform a collection of hedge funds over 10 years. Hedge funds, run by the smartest people in finance with access to proprietary research, insider information, and unlimited resources, versus a boring index fund that just buys the 500 biggest companies and does nothing. 10 years later, the results. Index fund, 125.8% return. Hedge funds, 36.3% return average. It wasn't even close. The simple index fund destroyed the experts. Here's why index funds win. Reason 1, fees. Hedge funds charge 2% annually plus 20% of profits. Index funds charge 0.03% to 0.20%. Over 30 years, fees destroy 30 to 50% of your wealth. Reason 2, you can't consistently pick winners. Studies show that 90% of actively managed funds underperform the S&P 500 over 15 years. Even the pros can't beat the market consistently. Reason 3, the market rewards time, not timing. The S&P 500 has returned about 10% annually for the last 100 years. You don't need to pick the next Amazon, you just need to own everything and wait. Example, $1,000 per month in the S&P 500 for 30 years equals $2.17 million. That same $1,000 per month trying to pick stocks and timing the market? Research shows the average investor makes about 4% annually because they buy high, sell low, and miss the best days. At 4%, you'd have $692,000. You just cost yourself $1.5 million by being smart. Buy a total market index fund or S&P 500 index fund. 3 good options. VTI, Vanguard Total Stock Market. VOO, Vanguard S&P 500. FXAIX, Fidelity S&P 500. All 3 charge under 0.10% in fees. Set up automatic investing. Buy every month regardless of what the market is doing. Then ignore it for 30 years. That's it. That's the strategy that beats 90% of professionals. But what about crashes? The market crashes every 7 to 10 years on average. It always recovers. Always. If you keep buying through the crash, you're buying stocks on sale. Those crash purchases become your most profitable investments. If you want the complete guide to index fund investing, which funds to buy, how to automate it, how to handle crashes, and tax optimization, check out Wealth on Autopilot. Complete strategy. Link below. Get the full automation system at automatedwealthbuilder.com.